Depending on how you choose to replace him, I think what happens today is an important game changer for the Canadian oil and gas business. There have been obstacles that were legislative, which is to say de jure obstacles, which could change. But there were de facto obstacles too. And I think those obstacles are gone, or at least have the potential to be gone, depending on how Canada chooses to replace her prime minister. And the equity prices around the Canadian oil and gas sector have been ridiculously cheap, even considering the constrained outlook for both Canadian oil and gas. So I think that Canadian equity investors in oil and gas can look forward to a double bounce, which is to say that Canadian oil and gas becomes attractively priced relative to its pricing, and the pricing changes as a consequence of a change in government. This, I think, will potentially be doubly true because of a change in U.S. administration. If both the Canadian federal government and the U.S. government decide to remove the constraints, the bottlenecks around the transmission of Canadian natural gas to European markets, both through the eastern seaboard of Canada, but also through the eastern seaboard of the United States. And if the constraints around the Keystone Pipeline, moving Canadian heavy oil, particularly sour crude, from constrained Canadian markets to really desperate U.S. Gulf Coast markets, the benefits that accrue to investors in Canadian oil and gas industry over the next 5 years should be substantial. Don't look necessarily for gains in 3 months or 4 months. Understand that markets take a long time to work, but something very, very profound happened today. And I hope that your listeners study that change and study how to take advantage of it.
Canadian oil and gas stocks are some of the cheapest in the world right now, despite sitting on untapped potential worth billions. With constraints like the Keystone Pipeline and bottlenecks to gas exports potentially lifting, Rick Rule says this sector is primed for explosive growth. Imagine this. Alberta natural gas sells for just $2 per million BTU locally, but fetches $13 in Europe. That's a $10 profit margin per unit, if they can get it there. And the math doesn't stop there. Rule changes in both Canada and the US could transform this industry, unlocking massive dividends, not just for companies, but for investors who act now.
For most investors, they don't need to get too fancy with this. If the whole industry reprices, what you learn in extractive industries is that these repricings are dramatic. And you don't need to go to the riskiest, most leveraged, highest alpha names. If you just go to the best names in the space, you're going to do fine. Choose 7 or 8 extraordinarily high quality names, own them for 5 years, enjoy the dividends, and watch your wealth change positively. This is really, really, really simple stuff. The only thing that can really get in the way of this is a synchronized global recession or depression that changes demand for energy on a global basis. I'm not saying that's going to happen or it's not going to happen. What I'm trying to say is that nobody's smart enough to know if it will happen. So you pay attention to bets where the odds are decidedly on your side. And the odds changed today. I don't think for Canadian heavy crude, no. The U.S. Gulf Coast refining industry was changed 25 or 30 years ago to take advantage of very low-priced, sour, high-sulfur oil from Mexico and Venezuela. Domestic policies in those countries have constrained their ability to produce by about 75%. The best way to provide the feedstock for those refineries is Canadian crude. The only thing that stands between Canadian crude and a market desperate for it is politics. And the politics may have changed in both countries. Does this change things in 6 months, 3 months? No. Change affects financial markets over 5 years, but this is profound change. Similarly, let's look at the gross arithmetic around Canadian natural gas, where your prime minister didn't see a business case. The gate price for Alberta crude, the AECO price, has hovered around $2 per million BTU for a very long time. That same gas delivered as liquefied natural gas in Shanghai or Tokyo or Rotterdam commanded about $13 per million BTU Canadian. And it takes about $3 Canadian to get it there. So add 2 to 3, you get 5. Takes $5 to deliver a million BTU of Alberta gas to Rotterdam, where it sells for 13. And your prime minister didn't see a business case for it. Interesting circumstance. The ability to access that market, which is beginning to happen anyway, as a consequence of liquefied natural gas facilities on the Pacific coast in British Columbia. But the ability to access European markets, either ultimately through liquefied facilities on the eastern Canadian Atlantic Ocean, or more probably through U.S. infrastructure, through U.S. export facilities, really becomes a game changer for the Canadian natural gas industry. An important game changer. Again, don't look for a market response in 3 months or 6 months. Look for a market response that is truly a magnificent response over 5 years. The U.S. domestic bases have challenges at this commodity price, with this cost of capital, with existing technologies.
Okay.
There are 3 aspects to the market, in addition to regulation, that matter. I suspect that the regulatory constraints are really, truly a thing of the past, at least for a couple of years. At today's commodity prices, with today's technology and today's cost of capital, it's estimated in the Permian Basin, the basin that I know the best, that we've already drilled 75 or 80% of our A locations. If technology improves, then we skate more B locations into A locations. If the pricing goes up, we skate more B locations into A locations. If the cost of capital falls, we skate more B locations into A locations. But with the current cocktail, if you will, of geology, technology, cost of capital, and commodity prices, I would suspect that in the most important domestic basin, which is to say the Permian Basin, that we're probably 2.5 years away from drilling out our best inventory. Marcellus is probably still a wide open gas basin, but that still leaves lots of room for Canadian gas. The traditional markets that you enjoyed into the U.S. Northeast and Midwest are increasingly going to be serviced by domestic U.S. gas. And without an expansion of the Canadian natural gas transmission infrastructure to the east of Canada, larger amounts of Atlantic seaboard and Canadian demand will in fact be met by U.S. gas. There'll be a bit of a gas swap. That notwithstanding, the demand for fossil fuels on a global basis continues to grow, at the same time that the global fossil fuel industry is underinvesting to the tune of $1 billion a day in sustaining capital investments. This deferral of sustaining capital investments in a capital-intensive business means 2 or 3 years from now that global production, absent luck, will be in decline. And Canada will potentially, with the political constraints removed, be a swing producer that will be important to global energy production and, of course, very important to the Canadian domestic economy. People underestimate the value of human capital in Canada around extractive industries. Canada punches way above its weight. Even in oil and gas, which has been deliberately sabotaged by your federal government. But it's important to note that Canada exports technology and human resources as well as natural resources. Canada punches way, way, way above its weight in mineral exploration and in mining finance, and punches way above its weight in terms of human resources around oil and gas too. It amused me that your government decided to subsidize, as an example, electric vehicle manufacturing or other economic activities where Canada had no definable competitive advantage, and ignore the industries where You had world-class respect for your human capital.